Hello everyone, and a big welcome to RJ Sanderson TV. Roy Sanderson's along for the ride, and it's tax time, Roy. You must be excited at this time of the year.
Hello, Dave. We do love this time of the year. We're very busy. July, August, September. We do a lot of personal tax returns, and then we shift into our trusts, companies and self-managed super funds. But winter goes very quick when you're working long hours. It's great. Love it.
So there's lots of people that have already put their tax return in for the 25 financial year.
Yeah, across the network of offices of RJS, which is 14 offices, we've lodged over 15,000 tax returns in the space of around 6 weeks. So we're happy with that. But the numbers across all of Australia, the tax office have issued stats suggesting that they're down 10% compared to the same time last year, which I find quite interesting because I would have thought people want their refund quickly, but
well,
not so.
There you go. There's still plenty of people that haven't lodged, and we've got some tax tips to guide them. The number one tip being, of course, visit rjsanderson.com.au for more advice. But let's get into our first one, and it starts with deductions. Roy, in particular, it's some challenging times out in the community at the moment for people. Regarding donations to food banks, so food donations, are they actually tax deductible?
They are, and I was out at Food Bank very recently. It's a fantastic operation, very worthy cause. So if you take food items and check their website, they don't want last night's leftover dinner. That's not what they're after. They want some items that are not going to perish. And they've got a list of things that are sort of suitable for donations. You take them in, there's a drive-through area, you unload the car, they will give you a tax-deductible receipt based on the value of those food items. Terrific service, and the fact that you can get a tax deduction for those donations I think is very important.
Brilliant, and a good cause, as you say, Roy. The next one relates to working from home, and it's an important point about record keeping. It
is, and the tax rate, tax office give us a rate of 70 cents per hour, which means you've got to keep a diary. Now, the old rules were just keep it for 1 month and we'll multiply it out by 12. They changed the laws last year. We now need to keep that diary for the whole 12 months and record the hours that you work in your home office. The 70 cents includes all those items: mobile phone, stationery, printer ink, internet and electricity and gas. So it's a very simple method. If you need a diary, go to our website. We actually have a complimentary, free, no charge diary that you can use throughout the year.
It's an important one, and we talked about some people not having lodged, but obviously that's a deduction that requires planning for next year. So make sure you get that diary. Another one that we're going to look at now may really put people off. No one likes the idea of having extra tax taken, but there may be another incentive for that, Roy.
So we often get asked when we're doing tax returns, how can I get a bigger refund? That might mean spending more money on deductions. But if you can forego $20 a week, you are allowed, under the law, to ask your boss to take extra tax out. You can't ask them to take less than the required amount. So if you said $20 a week, that's another $1,000 to your refund at the end of the year. You may not miss $20 a week, but certainly $1,000 is a lump sum. It's like forced savings. So we recommend that. Consider that as an option to get a bigger refund.
Another one of the tax tips that we've got for you today relates to holiday homes. Talk us through this one, Roy.
Well, in Victoria, we are getting asked about land tax almost on a daily basis. And people who have a holiday home, often when you buy a holiday home, you just put it in joint names, so husband and wife or two partners. It's better if the main residence is in one name and the holiday home is in the other name, because if you have two principal place of residences, one each, you may be able to avoid land tax. Certainly speak to your accountant before you do that, because we as accountants need to work out if there's a stamp duty impact, is there a capital gains tax impact. So work out what the cost might be, work out what you're going to save in land tax, and also capital gains tax in the future when the holiday home is sold. So talk to your accountant. There are options to reduce land tax in Victoria.
And you've got an example for this one. This case study sort of lays it all out. Talk us through this one, Roy.
It does. A listener to this show contacted us. She was living in a home. Her husband had passed away. The house was actually left to children from a prior relationship. But Bridget, this person, was given a life tenancy. The will was administered by state trustees. and the State Revenue Office issued a land tax notice. Bridget, rather distressed, she was on a pension, she couldn't afford the $975 bill, but she paid it. She managed to forego a lot of things and paid it. She felt it wasn't right, so she reached out to us to check it, and she'd rang the SRO a number of times, and their response was it's owned in a trust and therefore land tax is payable. And technically that is the case, but what they failed to look up is that if the trust is a testamentary trust, which means a trust that's activated upon death, and there's a life tenancy, and the person lived in the property before death and continues to live in the property after your partner has died, then there is no land tax. So after some back and forth with the State Revenue Office, they agreed to refund what was paid last year and waive the current year's assessment notice because she got another bill for $975. So great outcome. If you know anybody who's living in a property under a life tenancy rule and they're paying land tax, get them to reach out to their accountant or us and we'll help them out.
Yeah, I think the key message there, it's there's some big words and some big names in that one, Roy, so make sure you get proper advice. Make sure you reach out, rjsanderson.com.au. Another thing that's unfortunately on the rise, Roy, is GST tax fraud, and you want to send a message to the community here because there are some big implications for people that cheat the system.
Yeah, it's interesting, but people see this as easy money. They lodge a business activity statement, get refunds. The tax office issued this information very recently. Bryce had lodged $50,000 worth of false GST claims. He's been in prison for 18 months. Samantha set up a false business. The business didn't even exist. Collected $140,000, now doing 18 months in jail. Jade set up a dental laboratory, but faked all the expenses and claimed $230,000, 22 months in jail. And Shani set up a fake beauty services salon that actually didn't exist, said that she had expenses for her fit out of $4.4 million, tried to claim $440,000 in GST claims and is now doing 3 years in imprisonment. So, Dave, the message is just follow the rules. Don't think a sugar hit with an easy few $1,000s can be gained by lodging fake BASs, business activity statements. Just do it correctly.
Yeah, I think some pretty firm punishments there, so make sure you are following the rules, make sure you get advice, professional advice where necessary. Now, Roy, I know that you've got a few questions for me.
I do. I want to see how good you are at this. A teacher wants to claim a costume for book week. Do you think yes or no?
Maybe the fish example that you spoke to last time comes to mind. So within, you know, if it's a sort of average priced costume, I'll say yes.
The cost shouldn't have any bearing on it, Dave, whether it's $1 or $1,000. It's a costume. Is it used only for work? Teacher, book week, and they're not going to use it, wear that costume anywhere else. It's not normal clothing. So the answer is it's tax deductible. All you teachers listening, book week costumes are tax deductible as long as that's all you wear them for.
And book week this week, shout out to all the teachers out there. So there you go. If you're getting a costume for book week, it is tax deductible. Next question, Roy. What was the next one there? Hand
cream for a builder's labourer. So builder's labourer gets dirty hands, worn out hands, carrying stuff, and he wants to buy hand cream. Tax deductible or not tax deductible?
I'll say not tax deductible, not explicitly for work use.
It's classed as medical. So sunscreen is tax deductible, but hand cream, because you've got rough hands from work, unfortunately is not tax deductible. And there was a ruling very recently in the last couple of weeks specifically on this area. So I might have claimed it in prior years, but going forward, builders, you cannot claim hand cream.
Okay, there you go. Next question. What have you got for me, Roy?
Xbox purchased for workers to relax at the workplace.
Surely not. Surely not.
Well, the workplace is the workplace. We're not talking about home, because if it's home and you're just taking a break while you work from home, that is not a tax deduction. But a workplace like an office, if you buy an Xbox or a table tennis table or a pool table for the staff, they are tax deductible to the business, not the individual, but to the business. So the answer is a big tick, yes.
Well, there you go. There you go. To all the businesses out there, go and buy your staff an Xbox or a pool table or a table tennis table. It's tax deductible. And the final question, Roy?
Yes, legal fees. When you get a divorce from your partner, even if you're in business together, are the legal fees tax deductible or not tax deductible?
I'm going to say not tax deductible.
Not tax deductible. Even if it's a business partner, if you're getting a divorce, any fees you pay to the solicitor are not tax deductible. Now, there are 4 questions we've had already this year. I thought I'd share them so there's no confusion to our listeners.
There's so many machinations of these questions, and I'm sure the ATO is consistently and constantly ruling on these things, Roy. So I'm sure there's going to be more wacky questions that come up in our next edition, and we love those ones. They're always interesting. Another one that's interesting is directors' personal liability. There's a strong message here because some people wouldn't be aware of this, Roy.
Yeah, there's an obligation on directors to make sure that you have cyber security protections in place. If you just ignore it and you get hacked and data is exposed to the public, then you can be personally liable. And that's a huge shift in the legislation and the law that I don't think directors really know about. So make sure you've got something, talk to your IT specialist. If you're looking for options, go to our website. Under services, cyber security, we'll give you some options on who you speak to, what you do. Very important for businesses they start acting on this, because I would expect, given it's not well known, the next time this happens, if a director doesn't have the right protections in place, I think ASIC will take a hard line and use them as an example. And you certainly don't want to be the first person that's going to be sued under this legislation.
There you go. Make sure you are aware of that one and have the adequate protections in place. Now, let's get into the round table that has been put on the agenda by the Treasurer, Jim Chalmers. Roy, it's a big event, a lot of people talking about it, and it has implications not for just the short term, but the medium term and long term.
Yes, and these are some of the things that have been bandied around. I'm in favour of some of these. I'm actually in favour of GST going from 10% to 15%, and I know that's not a popular opinion, but the way you counterbalance that is you give everybody who's on government benefits a 5% increase. You increase your tax-free threshold. Now, the reason I think you do that so that people aren't worse off right now, but as the economy grows, then our 15% take in benefits will be higher, and we can have more tax decreases under the personal tax arrangements. I also think we should have a digital services tax. Google, Facebook, Netflix, the big tech companies, there should be a percentage of turnover you pay in tax, because at the moment their tax they pay based on profit equates to somewhere around 1.6% of their profit, because they shift profits offshore. It's very easy for them to do that. So let's just make a tax on turnover. Negative gearing. We have a housing crisis. Negative gearing was invented in 1936, and at the moment the shift is to hit negative gearing investors hard with, more compliance, higher taxes at state and federal level. I think we need to bring back some of the negative gearing benefits to encourage more housing investment. And I think we need a mega profits tax. Now, this doesn't have to be permanent. This might be something that you do for 3, 4, 5 years. But for any company that makes over 100 million, and CBA made over 10 billion, they pay an additional 5% profits tax for what's over $100 million. And that tax that they pay is not a franking credit that anybody can claim, so you're not getting it back. It will go to the coffers of the government. It will allow us to clear some debt, and we can move forward with no debt. And we probably need that for, on my numbers, between 3 and 5 years, and we will have the deficit fixed.
Wow, comprehensive. Well done, Roy. I want to talk to you just quickly about that event, the Economic Roundtable. It's obviously attracted a lot of media attention. There are a lot of people talking about this. A lot of people talking about the need for tax reform. We haven't seen sort of large-scale tax reform, the idea of adjusting the rate of the GST as an example. The GST has been in place since the 90s, untouched at that 10%. So that would be a very big position shift. And then even the idea of taxing turnover as opposed to profits. These are kind of philosophical shifts in how we tax. Is this a political stunt, or do you think we're going to see some actual change from this roundtable event?
I actually think we might see some change, and I'm hoping we will. I think this is not necessarily a political stunt. This is a way of getting the public on board with some changes that the government need to make to the structure of our taxation system. So it's not about they just come out and go, bang, here are the changes, because there'll be uproar, there'll be a backlash. Where what they're doing now is they're saying we're putting all the ideas on the table, let's pick and choose what we want and get the public on board so it's supported. Because at the end of the day, politicians are politicians. They want to be re-voted in. So they just can't go completely sideways and bring in stuff that hasn't got some support in the economy and from the public.
Interesting take, Roy. Appreciate your thoughts. I think the other one that that we haven't spoken about as part of that conversation is productivity. That is also another big piece of that puzzle, and I feel like that's also going to be addressed concurrently with all of these topics that are mentioned there. So it'll be interesting. Watch this space. We will see the fallout over the coming weeks. Roy, let's get into some of our more economic indicators, kicking off with the ASX and the performance of the ASX 200 over the last 12 months. We saw a small correction there at the back end of July off the back of more tariff news, but largely trending upwards.
Yeah, interesting. 12 months, you can see that big dip. And despite that big dip, it's been very strong since that dip in April, late April. And we've had a 12.3% return this year, which that's a good year. It's better than average. Average is about 8.5%, so we're above average. But I wanted to show the 20-year graph, because the 20-year graph just shows that dip on the far right side. You can see where that dip is, but whenever we've had a dip and all those little down arrows, we've always had a recovery. So interesting that stay in the share market. It's not about when you get into the share market, it's about how long you can stay in, because that's the sort of growth you're going to get over 20 years.
Inflation is also trending downwards, Roy, and we can see that it's now within the government's target of 2 to 3%.
Yes, now the red arrow is my arrow. I put that in to show where I think the sort of average is, and I think we're pretty close to where we want to be. We don't want inflation to go to zero. We want it somewhere about where it is now. So this is, I think, a good level right at the moment. We want it in this band.
GDP growth is also trending slightly in the right direction, and as your red arrow indicates, there's probably still a bit of a way to go to get to the right level, though.
Yes, exactly. So I think the economy needs a bit of a hit, a sugar hit, and that might be interest rates that we'll talk about in a moment. But I think that little highlight on the far right of this graph is that we need it to come up just a little bit, and that red line is about where the average is that I see is the right figure.
Downward adjustment to interest rates during the August meeting, so the interest rate definitely trending downwards, Roy.
Yes, and the two prior slides flow through to this slide. I think interest rates have a fair way to come down, and I'm not sure that they'll come down exceptionally quickly, but I think there's going to be some movements, and I think that we need to get somewhere around that 1.6 mark, because it was at 1.6 for many years, very stable. And I think we want stability, so I'm positive we have more interest rate reductions coming our way because of that prior slide with GDP needs a little heart kicker.
Confidence is still sort of reasonably flat over the last 9 months or so, Roy?
Yeah, interesting, isn't it? The 12-month bar graph on the left-hand side of the screen shows us that it has been flat. We're still under 100. And then I thought I'll just check the 3-year mark. And if you look at the last 3 years, we're not doing too badly, which surprises me. Yes, we have dipped last year, where you can see early in that 12-month bar graph. But over the 3 years, I would argue it's heading in the right direction.
House prices across the country, Roy, and the home value index is a good indicator of that. How have the last 12 months looked?
Yes, interesting that the average is 3%. Melbourne, 0.5% in the last 12 months. So it has kicked up over the last 3 months. You may remember the last time we looked at this graph, Melbourne was negative. So the 3% is the average. But look at Darwin, Perth, Adelaide, Brisbane. They're all flying, holding us back as Sydney, Melbourne, Hobart. So I just thought I'd share that because house prices, that average, when they talk average, 3%, if you took out those 3 bad states, you know, that average is up around 7% for the rest of the country.
And obviously house prices have an impact on the rental increase and the rental yield. What's rental market looking like at the moment?
So this is the increase percentage. Currently we're at 3.7%. And remember, it was a few years back, post-COVID, rents went through the roof. They were increasing at 9 and 10% every year, and they continued to increase it around between 7 and 9% for a number of years. They're now back down to a 3.7% increase, and I think that's about where we need to be, somewhere around that 3% to 4% mark. So I'm sort of hoping that that levels out.
So, Roy, question without notice on that, 3 to 4%. We saw the stock market 12% up year on year. And you've mentioned before that we're in the middle of a housing crisis and we need more property investors in the market. If rental yield and rental increase is only 3.7%, how is that going to be an attractive sector for more investment?
Because when you're a property investor, you look not just at rent return, and that's rental increases. You're also looking at the property market increase over time. So it's not just rent, it's also the capital growth. Compare that putting money on a term deposit. If you put $100,000 on a term deposit, in 3 years or 5 years, it's still worth $100,000. So rent return plus capital growth is what you consider when you're looking at a property as an investment.
Great information there throughout on the economic indicators. Let's get to a few more viewer questions, Roy. We love these ones because they're always quirky and interesting. And this one is just a generally interesting. What is the biggest tax refund you've had this year? So
we're 6 years in. The biggest refund so far this year is $39,050.
Wow. 39,000. Now, there's got to be some sort of catch here. How does someone get to a $39,000 refund?
Well, the person did have a one-on-one appointment with me, in this case, but with their accountant. And what we talked about was what they could do before June 30 that would allow them to get a bigger refund. While they were working, and their super balance was under 500,000, so we were able to back pay some contributions to super. So a big amount went into super just before retirement. They retired partway through the year, which meant that the amount of tax deducted for their 7 months worth of work was more than it needed to be, so that added to the refund. And they had a negative geared rental property, and that added to the refund. So all the stars aligned. We had the meeting, we talked about what they should put in to super as a lump sum to get the tax deduction. They did it, they followed what we suggested. 39,000, I got to tell you, they are so happy.
I can imagine. It'd be very handy 39K just jumping into the account. Next one is an interesting one as well, Roy. It relates to electric cars. I have an electric car that I use for work. I charge at home. Can I claim any part of my electricity bill for car charging?
So the tax office give us a rate per kilometre for electric vehicles. It's 4.2 cents per kilometre. So look at how many kilometres you've done for the whole financial year, multiply by 4.2 cents, and that's the dollars that we claim as power charging cost for your EV. Assuming it's 100% for work, if it's not 100%, then you'll multiply whatever the percentage is for work as per your logbook.
So it's effectively translating the same logic as claiming other car costs, but just applying a different rate for the electric car.
Correct. It's not covering the rate. There is one rate, which is 80 cents or thereabouts, which covers all the car costs. and that would include electricity if that's the rate you're using. But if you're using a logbook method as a percentage from anything up to 100%, then that under that logbook method where you claim the actual costs, including insurance, rego, repairs, and normally it would be fuel. In this case, it's power.
There you go. Another interesting one relates to giving gifts. I plan to give money to my children so they can enjoy it while I am alive. Do they pay gift tax in Australia?
So in Australia, there is no gift tax at all. It doesn't exist. And hopefully after this economic roundtable, it doesn't exist. It does exist in some countries. Chile, Denmark, Finland, France, Germany, India are some of the countries that have gift tax. It doesn't apply in Australia at this point in time.
And a point of clarification on that, so the person obviously has to be alive. This is different to inheriting an estate, and there are tax implications for that now?
The tax implications for inheritance are that if the money goes to a dependent, so husband passes away, goes to the wife, they live together, that's a dependent, then it's tax-free. If it goes to a non-dependent, so adult children, they've moved out, they're no longer dependent, living in the family home, the superannuation proportion of the inheritance is taxed at up to 17%. So there is some tax implications. With estate planning, very important that you talk to an accountant or who will put you in touch with a financial planner who's an estate planning specialist, because there are some ways to avoid that 17% if you do some things while you're alive. It's important from the perspective of an inheritance is that you've really got to plan it well in advance, Dave.
And rjsanderson.com.au to get in touch and get onto that, because they're, as you say, they're important conversations, and you can only have them to a certain point, and then unfortunately health gets the better of you, and you need to have those conversations in good time.
Yeah, so I might say there's no tax on gifts, but the reality is it's got to be a genuine gift. It can't be that my boss just gave me a $10,000 gift when really that's a work bonus, so that's going to be taxed. The rules on gifts are got to be genuine gifts.
There you go. Right. The next question relates to tax deductions, Roy, and in particular tax deductions without receipts. In the last federal election, there was a promise that we would be permitted up to $1,000 tax deductions without receipts. When I did my tax return, the accountant said it was still $300. Is this correct?
Well, it is correct, and there was an election that promised up to $1,000, no receipts required. We thought that was fantastic, but that doesn't come in until the 2027 tax return. So that's still a few years away, or a couple of years away. Interesting, it comes in just in time so that you'll be having your refunds before the next federal election, which is in potentially as far away as May 2028. So they've timed this change in legislation from the last election promise that it comes in and the benefit is just before the next election.
What are the
Great
chances?
Politics.
What are the chances, Roy? Speaking of politics, this segment sometimes veers into the political lane. Sometimes it goes in other directions. We don't know where it's going. Where is it going today, Roy? It's Roy's Rage. And what have you got for us?
Well, I just think there's an absolute need for people to start looking at what's causing scams. There are so many scams out there. The email addresses, fake websites. I think the governments, the tech giants and the banks need to get together, and they need to start putting pressure on the people who, one, register email addresses, two, register websites, and say if it's not a genuine email address, or you can't identify who owns that email address, or you can't and that's with proper ID I'm talking about, and you can't identify that that's a genuine business, then close down the website, close down the email address, and put some responsibility back to those people, those companies that issue websites and issue email addresses, to say you had the responsibility to make sure these are legitimate people. And that, if that means showing ID before you open up a new website or open up a new email address, then so be it. But get rid of all the scammers that are out there.
It's such a logical, good call, Roy. Like that is, there are scams out there, and often it is implied that it's the responsibility of the victim to avoid the scam. But as you say, there's not enough focus on the scammers and getting to the bottom of it. It goes squarely into the too hard basket, and nothing's being done about that. You know, there's all these education or public education efforts out there to avoid scams. How about getting to the source of the problem and fixing that? I'm with you 100% on that, Roy. That's it, Roy. We've covered plenty of tax tips, some quirky and antagonistic tax questions, and how to look at all the economic indicators. We've got another ep in September. Looking forward to that one. Any predictions ahead of that?
Well, I think consumer confidence will continue to grow. That's on the back of interest rates coming down, and I think some of this economic roundtable stuff that's going on at the moment could be interesting few years in the taxation space where changes are about to be made. Having said that, there's always changes every day in my industry, the tax accounting industry. There's changes every day that we need to stay on top of.
Looking forward to more quirky tax questions next time, and also all the fallout from the economic roundtable. Thanks for watching RJ Sanderson TV. We'll see you next time.